Welcome to Investors Insights. Our topic today is debt up, fuel down. Yes, we've got a lot of topics to cover this morning. We're going to talk about the debt ceiling. We're going to talk about inflation and your fuel prices. And we're going to talk about your portfolio. And we're going to talk about market strategies in May. So stay tuned here as I bring on my colleagues, Bobby Norman, Trey Booth, and Tom Miller, all part of the Five Plan Partners Portfolio Investment Strategy Committee. Gentlemen, it's great to be with you this morning. Really appreciated the work you did over the weekend and early this morning on research. Bobby, let's start off with you just because you talked about the debt ceiling, and that's going to be a hot topic this week.
Yeah, this week's market moving event that we're watching carefully is around the debt ceiling debate. And so we actually have the House Speaker will be at the New York Stock Exchange for a speech where we expect him to call for a spending cut as part of the debt ceiling conversation. Obviously, investors will be watching carefully. And when we have these type of events like this, we always like to see how the market has reacted historically with similar events. So we took a look back to 2011 when the House Speaker then spoke to the New York Economic Club. And what's interesting is, as you can see in this chart, is the price action of the S&P 500 this year looks almost identical to the pattern we saw in 2011. It was at this time, an exact point in 2011, that where we really understood that we had a bigger problem in conversations around the debt ceiling and getting the debt ceiling higher. And the same is true today. Now that the policymakers are starting to focus on the matter, the debt ceiling conversation debate will likely cause uncertainty in the markets, and it's something that we're watching carefully over the next few weeks and months, and we'll continue to keep the viewers of this vlog updated on the markets because, as always, politics do matter, and it's getting close to that time when the debt ceiling will be more of a conversation.
No, you're absolutely right, Bobby, and it can get emotional at times as well, and the media can build things up, but dialogue's taking place, and so we will keep our clients and viewers informed as to what's going on there. Also, folks, let me say this. If you've been watching our vlogs, you'll notice a trend here. One of the topics we've had is we've talked on Facebook and Twitter and YouTube and in our podcasts. It's in regards to inflation. And Trey, again, this morning, inflation is just the topic or theme so far for 2023. And give us some insight on that as the Fed has raised interest rates. And we've talked about this throughout our blogs. People can track us. So go ahead and share your thoughts.
Yeah, absolutely, Greg. So last Monday's vlog, we were looking forward to the inflation report because that has been the data point that the market has moved off of for the last, feels like 12 plus months. And it came in better than expected at a year over year change. CPI, that's the Consumer Price Index, grew at 5% year over year. That's better than expectations, which were 5.4. And even more importantly, that puts CPI right in line with where the Fed funds rate is, which is 5%. That's the point we've been looking forward to since late last year. And so we were surprised when the markets didn't rally off that data point. It actually kind of took it in stride, little ho-hum, not a big sell-off, not a big rally. And so we had to look under the hood to see maybe why. Why would the market not take this so positively? And it's likely because what drove CPI down was the very volatile food and energy portion and used cars. So very happy to see that fuel was down year over year. Motor fuel was down 17%. That's a large drop. But
That's
with
a big
OPEC,
drop.
Exactly. But with these are year over year numbers. But with OPEC announcing a major cut in oil production that starts in May, the market is kind of looking through that number of this month and expecting oil prices may be down now, but it's not going to stay. And so this may be just a downward blip. And then used vehicle prices were down 11%. That's phenomenal. A lot of our clients in the market were used vehicles or new vehicles, but new vehicles were up 6%. And so that's not really, those aren't consistent indicators. And so that may be why the market took what was a very positive inflation number to see it flatline with the Fed funds rate at 5%. Took it a bit in stride. So we're kind of looking forward. Maybe these data points will pass through, but to us, it's still positive to see inflation come down. And it's coming down in a symmetrical way that we predicted going back into late last year. And so it's something we're watching and taking as a positive sign for maybe some long-term growth.
Yeah, and I really appreciate you bringing that to everyone's attention as we track inflation. That's kind of pulling the curtain back to see the details that could impact our clients' portfolios. So the media will pick up a lot on this whole debt ceiling issue, but they may not address some of the inflation issues. And we're watching that very closely. And then, Ty, you talked about that in the volatility that we've seen so far this year and the knee-jerk reactions between media and markets and commentary, that people will go, well, gosh, what about that old rule, sell in May? That's been around for all of my career. And I thought you pulled out some great data to show that that may be a saying that you don't have to count on. So talk about that.
Yeah, so sell in May and go away, popular saying, everyone kind of knows it, but does it hold water? Well, over the last 20 years, I have some data points here, and just in the last 20 years, there's only 3 instances where the market was actually negative from May to October. The average return, about 4%. As you can see here, it comes from a bunch of different sectors. There's not one outperformer. Overall, 4% gain, that's about, half of roughly the market gain in just May and October. So sell in May and go away might not have as much relevance. Now, one interesting tidbit that I saw was, this saying kind of came about from when the U.S. was more industrialized and factories and plants would shut down for a month over the summer and allow people to vacation, kids out of school, things like that. Well, now where we're at in society is more digitalized. We're not really taking that month off. So, earnings won't really be affected. Companies aren't shutting down. We're working a lot more. So in that regard, we probably don't have that dip anymore. But again, past performance is no guarantee. So we'll kind of see what's going on this year as we approach May.
Well, I thought your timing was perfect on that because here we are and Bobby's talking about debt ceiling and the emotions that come with that. Everybody's focused on inflation and will the Fed raise rates and what's the impact of that? Simultaneously, we're getting positive news of inflation coming down, prices coming down on that. I think the debt ceiling will probably get resolved. And so we may be looking ahead at some very good weeks with the market. No guarantees, but we're going to watch it closely. So folks, we thank you for taking time out to watch this vlog. We thank you for sharing it with your neighbors and your friends, family, and colleagues. And we also thank you for the opportunity to constantly give you information like this, whether it's through these vlogs, our social media, the one-on-one appointments, or also the virtual appointments, which I have to talk about now. And so we're going to keep you updated. Looking forward as we continue into 2023, cannot believe that we already are in the first month of second quarter. We hope you have a great week. Thank you, and know that every day we come into this building striving to see to it that our clients have a better, richer, fuller life. Take care. Talk soon.